What's up everyone, it's Scotty with MoneyVest. So in this video we are going to be talking about one of my favorite companies in the retail sort of consumer discretionary sectors, and that's going to be Lululemon. We're going to do a complete analysis on this company, and I've actually made some adjustments in my intrinsic value calculator as well and my spreadsheet. So I've now accounted for the free cash flows as well, and we're going to discount all those free cash flows back to present values. So discounted cash flow model is also included. We're going to apply a weighted average for these models to better understand where the fair value might end up being, including for both earnings, which is net income, and free cash flow as well. So I hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. The first week of the month is the best time to join. And of course, you get access to all the buy and sell alerts, options alerts, trade ideas. Everything is going to be included with the link down below. And don't forget, our Labor Day sale is going on right now. We've got a 50 to 60% discount on fundamental analysis, technical analysis, and the options courses. The coupon code is going to be Labor4, and this does expire on Monday night. So again, I'm working on another course, Psychology of Investing and Money. That's going to be available later this month, but this right here is currently 50 to 60% off, and including the bundle, which is also 60% off, and the coupon code, like I said, is going to be Labor4. So if you go over to some of the numbers that Lululemon reported, they once again reported some very, very robust numbers in terms of revenues and earnings and guidance. So they upped their guidance after strong growth in China boosting quarterly sales. So EPS came in at $2.68 per share, which was better than expectations at $2.54. Revenue came in at $2.2 million, again, better than what the expectations were at $2.17 billion. And sales rose about 18% on a year-over-year basis to $2.21 billion. That's up from $1.87 billion. And the top and bottom line beats were fueled by strong growth internationally. The retailer saw sales jump 52% in the market outside of North America and boosted by 61% increase in China. That's up 30% growth in the region in the prior year quarter as well. So very, very strong numbers coming in. And the CFO, who is the chief financial chief, Megan Frank, basically said that the sales growth was, quote, strong and healthy even as China's economy slows down, with retail sales up 2.5% year over year of this July. And CEO Calvin McDonald said that both e-commerce and in-store sales are performing incredibly well in China. The retailer now has 107 stores in the country, and 35 are planned to open internationally during the current fiscal year as well, and the majority will be in the region, is what they mentioned. And sales in North America were also up 11%. Meanwhile, same-store sales across the global business fell short of expectations a little bit. Comparable sales were still up 11% year over year compared to an estimate of 12.1%. So nonetheless, very, very strong growth. And they also have this ambitious growth plan of the power of three, something that I have talked about in my previous videos on Lululemon, that they are very ambitious coming from 2021 all the way through 2026. They've got a very nice target of doubling the revenues from 6.25 to over $12.5 billion. And to get there, the company's been working on expanding its brick and mortar footprint and double its men's and direct to consumer revenue as well. So this right here has been the fundamentals for the company, just absolutely incredible. You can see the consistency, you can see the bar graphs over here and how well the company has grown over the years from $1.6 billion in revenue to over $8 billion, and of course approaching the $12.5 billion target they've set for themselves by 2026. Gross profit, very strong margins, $857 million, growing to over 4.4, almost $4.5 billion. And operating income also is up from $400 million to over $1.7 billion for the company as well. So again, very nice consistent growth here. We've got net income also moving in the right direction from about $250 million to over $854 million, and shares outstanding has been going down from 146 million down to 127 million shares outstanding. So consistent share buyback, consistent growth in revenues, profits, operating income, and net income. And you've got excellent margins at 56% gross margins. You got free cash flow margins of 9%, net income margins of 11.4%. It is a brand consumer item, so you don't expect margins to be super high. And we got very, very efficient business with return on capital, assets, and equity sitting pretty strong. And CapEx is only about 7.5% of sales. Now, this right here is one more metric that we have talked about, which is net income per employee. That's slightly down from its 5-year average of $31,800, so it's now under $30,000. Something to pay attention to, obviously, closely, because as the company grows and hires more people, this is a very, very important metric. That's so that it tells us that, okay, they're actually putting these new employees to better use to increase profitability so that per employee profitability is increasing. So companies becoming more efficient over time. There's an operating leverage that's kicking in for the company. Now, speaking of free cash flow, as we are now going to start to include the discounted cash flows as well into our models, 130 million grown to over $800 million on a trailing 12-month basis. It's been a little bit more fluctuated because of the CapEx, because you can see the net capital expenditures have only been going higher. So you can see that they've gone from $106 million to over $665 million. So free cash flow is nothing but operating cash flow minus CapEx. So that's why the free cash flow has been a little bit back and forth. And that's primarily because the company is growing its global footprint to achieve that target of $12.5 billion and of course continue on their ambitious growth plans. So accounting for this, and by the way, I do get a lot of questions, levered versus unlevered. I use the levered free cash flow. It's basically the free cash flow after accounting for all financial obligations for the company. So it is a little bit lower, but it's a better guide for us to understand on the free cash flow side. So that's what I use, levered free cash flow after accounting for all the financial obligations. So if we go over to earnings expectations, 12.16, that's going to be a 20% growth, expected to grow to over $45 per share. So very nice, consistent growth expected from analysts and the markets as well. Now, valuation is a little bit on the higher end. It has come down from its 5-year average. So it's trading at about 33, 35 times on a non-GAAP basis, trailing versus forward. And price to sales trading at a little bit under 6. Price to cash flow just under 28 to 31 right now. And we got enterprise value to EBITDA trading at about 20 to 22. So it is an expensive stock and it's there for a reason because it's a very high quality name. Now, balance sheet's not that great either because we are sitting on about $1.11 billion of cash with just about $1.2 billion of debt. So it's not the end of the world, but they do have a positive net debt of about $86 million, which again is not crazy, but it is slightly higher. Same thing with debt to free cash flow. It's just slightly higher than what we look for. We look for this number under 3. It's at 3.04. And current ratio is very strong, but quick ratio is 0.88. That tells us the company still is sitting on a lot of inventory, right? Because quick ratio basically takes inventory out. And once you take inventory out, you want to have short-term liquidity, which is a quick ratio, to be over 1. Right now, it's just a little bit under 1. So balance sheet is kind of like borderline okay because cash to debt's just slightly under 1, debt to free cash flow just slightly above 3, and quick ratio is slightly under 1. So it's not the best balance sheet, but it is not the worst either. Now, this right here is the second quarter numbers that the company just reported. So net revenues increasing 18%, total comparable sales up 11%, direct to consumer net revenues represented 40% of total net revenues compared to 42%. For the second quarter. That means their digital sales are actually growing and gross profits increased at 23%. Income from operations increased 19%. So every single metric across the board did increase on a year-over-year basis. Okay, so this is the new model and it's going to look a little bit different at first, but what we have really done here is that we are now accounting for both the earnings and the free cash flow, and I've included this right here, which is EPS percentage and free cash flow percentage. And what this is going to tell us is take the weighted average for the actual intrinsic value, right? So it's up to us, it's up to me at this point from an analyst standpoint to figure out, okay, do I want to allocate 100% of my fair value to be dependent on the earnings and the net income for the company, or do I want to split 50% between the earnings and the free cash flow, or I want to do 70-30, 60-40. So that's what we're going to analyze. Most of the case, I'll keep it 50-50 unless there's a little bit of a more reliable free cash flow, more predictable free cash flow. That's when I will go a little bit higher on the free cash flow multiple. So what I'm really going to be doing is I'm just going to plug in 50% here, and that'll automatically update the free cash flow percentage of 50%. If I want to go a little bit higher on the earnings weighted average, let's say 75%, it's going to automatically update that to 25% for free cash flow. And this is the weighted average is what we're taking for the intrinsic value. Okay, let's get right into it. So this is the earnings per share, 2024, $12.16 expected, 2029, $26, and 2033, just under $46. So we are expecting for the earnings to grow by a little bit over 15 to 16%. That's going to be that growth rate for the earnings. Now, free cash flow per share, we don't have an expectation. We don't have an estimate for what that's going to look like over the next 5 years. So what I do have is the free cash flow growth from the last 5 to 10 years. So 2014 was 130 million, 2018 just under 307 million, and trailing 12 months 2023 is just under 810 million. So that growth rate for Lululemon in the past has been just under 24%, right? 23, 22%. So now we have a pretty good understanding that, okay, in my opinion at least, I can grow the earnings for Lululemon net income wise by a reasonable 12 to 14%, right? So I'm gonna do 14% here for Lululemon in terms of that net income growth rate, right? So that doesn't change; it's still the same. The P multiple, again, valuation wise, right now it's trading at 35, closer to 36 on a non-GAAP basis. 14% growth rates expected over the next 5 years. I really don't want to be paying 30, 35 times P multiple for a business that's growing at 14%. I'm going to keep it at around 25 because it's still a very, very high quality business. It's just that the growth rate's not that high to be demanding a 30, 35 times P multiple. So I'm going to keep it at 25. So now we come to the new part, which is the free cash flow growth rate, right? What is going to be that growth rate for the free cash flow, that's operating cash flow minus CapEx for the company? And we know that in the past, it's grown at around 22, 23%. I'm going to be a little bit more conservative. As always, I'm going to go with 20% for this number right here. Now, free cash flow multiple, right now, as you'll notice, if you come back to valuations, it is trading at about 28 to 31 times free cash flow multiple. Again, a little bit more on the expensive side. So I'm not going to go with 30, 31. Let's just keep it steady at around 25 also for the free cash flow multiple. Discount rate. Now, for the discounted free cash flows, there's a lot of analysis that goes into the discount rate because there's the cost of equity, there's the cost of debt. So for calculating cost of equity, we use a capital asset pricing model. It gets way too complicated. There's a lot more calculation to this if you want to be very, very precise and be a lot more specific. And that's exactly what the courses are for, right? So this literally just goes into a lot more detail, going over the fundamental analysis and going over the how to calculate your discounted cash flows by using the actual cost of equity, cost of debt for the company, so for us to figure out what that discount rate is going to be using what's called a weighted average cost of capital, right? Or WACC. We're not going to do that because, like I said, it gets way too complicated and a lot of detailed analysis is required, and I can't do that in every single video, right? So again, if you want to learn how to do that, that's available in the courses, 50% off, coupon code LABOR4. So we're going to keep that steady at around 12%, as we have always done. I think the dividend yield is around 0, so they don't pay out a dividend, so 12% is pretty reasonable. 10% margin of safety, and when it comes to share dilution, they have bought back about 1.5% worth of shares every single year, so we're going to keep that intact at minus 1.5% here, and I'm going to keep it at 50-50, right? So 50% weighted average for the intrinsic value, and we end up with an intrinsic value of about $314 per share. The formula has gotten even bigger after I've accounted for the free cash flow here, $314, and right now the price is trading at around 404. So 404 is where we're at, meaning that 22% potential downside needed for Lululemon for it to come down to trade at the intrinsic value after accounting for both free cash flow and earnings per share. Now look what happens, how the fair value changes if I change this number right here. Let's say that I only want to go after the earnings per share. If I only want to rely on my intrinsic value based on the net income for the company. If I hit enter, now you'll notice the fair value jumps to $367 per share. That means only a 9% downside needed. So if I were doing this originally, if I were using my original model only by using the net income, then the fair value would have been a lot higher because, again, 14% growth rate, P multiple 25. I still think the P multiple is a little too high at 25 for Lululemon, but you get the idea, right? It jumps up to 367, but since we're using a weighted average now, we're going to go 50%, and now the fair value is closer to $314 because it's accounting for both the net income and the free cash flow as well. So that's going to be the final value. I still have to work on the sensitivity grid because there's going to be a lot of formulas. This one's already way too long to go over. I'm going to update those to account for the free cash flow as well and the weighted averages. So there's going to be a lot of updates on this one as well. But nonetheless, that's where my fair value is going to be. Very, very strong company, absolutely phenomenal business, very, very strong area of demand for Lululemon inside this green rectangle, sitting roughly at 255 to as much as 280s. So this right here is going to be that support level, and a very nice swing trading opportunity is also going to present itself sub $300 per share. It's already up close to 42%, coming up to its resistance. Right now we are approaching a resistance level for Lululemon, something to keep in mind. And of course, next target, if we do end up breaking out above this resistance, the next target and the resistance is pretty much going to be the all-time high for Lululemon, sitting roughly at around $481 per share. So I hope you guys enjoyed this video and a complete update on this company. Let me know your thoughts down in the comment section below. As always, make sure that you drop a like, subscribe to the channel. Link to our Discord Patreon is going to be down below. There is the first week of the month, the best time to join, and of course the Labor Day sale. Coupon code LABOR4 for courses, fundamental tech analysis, option scores, 50 to 60% off. As always, happy investing. I'll see you all in the next video.